I think founders want two things: to raise their next round and to exit. Most people won't admit it, but that's the truth. Brian Wong doesn't sugarcoat the startup game. And that's exactly what makes this conversation essential listening for founders, operators, and investors alike. In today's episode of the Mike Method, we dive into the mind of Brian Wong, a prodigy who graduated from the UBC Commerce Business School at 18, when most people are graduating high school. Raised over 40 million in venture capital, built Keep, one of the world's largest mobile advertising platforms, before selling it in 19. Now based in New York City, Brian leads Ascii Ventures, a next generation fund that's flipping the traditional VC model on its head. After more than a decade in the trenches as a founder, Brian's building the kind of fund he wishes had existed when he started, one that's truly founder friendly, helps ensure the next round gets raised, and brings real world operator experience to every deal. In this conversation, we explore how he went from being laid off in San Francisco to creating a global tech company at 19, why humility and coachability are the ultimate leadership superpowers, the unique founder-centric incentives driving Ascii Ventures, how stablecoins and crypto are quietly reshaping mainstream finance, and why it's already happening beneath our feet. If you've ever wondered how the best investors think or what makes a founder truly fundable, this episode delivers a masterclass in both. Let's dive in. Brian, I really appreciate you making time to be on the podcast today.
Thanks for having me, Mike.
Yeah, absolutely. So, you and I met 20 years ago at a UBC Commerce event, and I honestly can't believe that 20 years has flown by since then. And since then, you've had the most phenomenal and fascinating career and entrepreneurial journey now into investing. As a place of grounding everyone who's listening to this, I'd love if you could just take us down the garden path, walk us through from startup founder to today, so that we have a deeper understanding of who you are and why you're doing what you're doing right now, and then we'll dive into what you're truly passionate about today.
For sure. So the journey started off at UBC, I guess, in a professional capacity. Decided to go into marketing and as part of commerce. And I actually did a little bit of studying in political science, and that was just because I had this random thought I wanted to be a lawyer and maybe go to law school, and that could have been interesting, but that path never materialized. I graduated in 2009. Economy, as many recall, was not so great for jobs right after the financial crisis. Being tech forward, and the fact that I had started doing graphic design, I had kind of plugged into a bit of the startup ecosystem. I was following some big characters in the startup world, like this guy named Kevin Rose, who was quite famous at the time, who was running a company called Dig. And I ended up going down to San Francisco and getting a job there in 2009, right after I graduated. So I ended up spending, the first half of my career in San Francisco. I was working at Dig. I ended up getting a job there as well. So I actually worked for Kevin. And then I got laid off and I started my first company. So my first company was called Keep. It was in mobile ads. We came up with this concept of turning ads into a rewarding concept rather than something that was subtracting from people's attention. So the idea would be you finish doing something in an app on your phone. Could be a game, you could finish a level, you could finish a workout. And in that moment in time, you could get rewarded from a brand instead of just a simple ad that could be really annoying and kind of just be in your face. We kind of try to change the value exchange away from just an attention thing that was one way. Brands are just, hey, look at me, to let me give you something back as well. Let's make this something that's mutual. So that was the start of, I think, a pretty fundamental shift in how brands interacted with consumers that now is quite normal. Right? I think people are very normal. It's very normal for people to see, brands are going to give me something. We're going to have this rewards program, and nothing more clearly obvious than credit card programs. And it's just a very obvious exchange, right? You just do something and you get something back. And, but at the time we started the company, a lot of brands were looking at me like I had a third eye. They're like, what do you mean you want me to pay people to interact with my ads? This is just really crazy. And so that was really the start of something real cool. So we built this company for 9 years, my co-founders and I, and I think we built something quite amazing. It was really kind of changing how people viewed the value exchange, like I said. So I built that thing up until 2019. We ended up selling it in 2019 to another ad tech company called Ninth Decimal. We shared investors with them. Verizon Ventures, North Atlantic Capital. We both had the same investors. We ended up kind of bringing them together. And then the following year in 2020, another company acquired the merged entity called In Market. So there are two transactions in 2 years. And then in 2020, COVID hit, as we all know, and I decided to take a couple years off. I had already, spent 9 years building a company. At the time, I was pretty exhausted, and the world was kind of telling me, "Hey, maybe you should probably take a break," because a pandemic just descended upon all of us. So I was like, "Okay." So I took the time off, focused on my health. Did yoga, learned how to play golf, very cliche things, meditated a bunch, and then started a new company in the crypto space just because I had already been spending a lot of time in that world. I've been working with that business as a co-founder and kind of as kind of like an operating on the side partner, not really the CEO. My co-founder is the CEO of that business, but I was helping build that business for a few years. And then this year decided to start a VC fund. Very long-winded way of explaining kind of the trajectory. But here we are now, 2025, cracking away.
I mean, it's quite a fascinating story to go from, leaving business school. The year you graduate is post 2008 recession going into 2009, a really tough job market, to get down to the States and land a job with with Kevin Rose, who's, a big deal in the tech space. To take that to go to Keep, to do something that had not been done in the ad space, which now we all think is commonplace. If you're playing the home game and can remember back then, like what Brian was doing was nobody was doing it. To take it from there to, two transactions and then taking some time off. I mean, the logical next step for you once you've, gone from the founder to the, operator through to transaction is to take that knowledge and wisdom and say, okay, so I can start companies or I can invest in companies, which obviously, now leading into the fund, clearly you see a hole in the market. There's lots of, VCs and private equity firms out there that are constantly looking at deals, but I think you're looking at the market in quite a unique way. And I'd love to hear more about how you want to change the way that investing is viewed through this fund.
Yeah. The obvious thing was I had, before starting this fund, 13 years of pattern recognition in being a founder in the trenches, either on the side of pitching and asking to work with VCs and trying to get them to invest in my company, and then also with peers. So we were always on that side of the table. I'd say 2018-ish, I started to invest as an angel investor. This was mostly because it's trendy in my friend circle, right? So when you think about the things that people do, it's usually just really backed by peer pressure, right? It's no mystery that bankers love to play golf because everybody plays golf, and so you just end up playing golf. Investing was one of those things. Now, angel investing is a very different animal than being a VC, as much as they're kind of closely related cousins. As an angel investor, you're kind of going in there, you're like an angel, you're kind of just floating around, you see a cool company, boom, we come in, like, and we give you whatever. And there's really no like obligation, because an angel comes into your life, they weren't obligated to show up in your life. You just kind of accept it, you're happy about it, and life moves on, right? So the dynamic is super interesting and it's super fun. Is the conclusion, right? Like, as an angel investor, you get to meet cool founders. You only get involved if you really wanna, and then everything is gravy from there. And then you expect to lose pretty much all your money because it's more of a recreational thing. You're angel investing because it's my personal reasons were, and I'm not saying this to offend people, but as you get a little older, you start to spend less time in areas that you don't understand, right? And there's going to be young people that spend time in those areas that they understand because they were native in that space. And the best way, I think, to learn is to just buy your way in. You invest, you spend time with the founders, they're the experts at it. And you just sit there and you watch how they build their business, and it keeps you very relevant. Mm-hmm. So investing was one way to do that. The other was just, again, to experience it. Like, how can I help? And can I help push these companies to grow even faster? Is my involvement going to help make my own investment increase itself in value too? And the answer was yes, because I'd spent, 10 years building Keep. And it was the litany of people that I met from other VCs to a very important network that I built, which was CMOs, right? So big brands, lots of CMOs, a lot of marketing people, which was a network that a lot of startup founders did not have spent time doing. But a lot of companies realize they want to, partner. Tech companies realize they need to partner with traditionally large companies. Like who doesn't want a Pepsi or a Starbucks as a customer, right? Especially if your product is relevant to them. So that was something that I could help with connecting to big brands, connecting to other investors, and frankly, just my own insights and kind of having spent time in the trenches for so long. Anyway, that being said, it was a lot of pattern recognition. And I said, well, I'd always wanted to start a fund, right? Because I wanted to have the ability to not just have one horse in the race, but, 40 or 50 in the race. And then know that if I'm spending an hour a week or a few hours a month with that company, the impact that I could make could save, months of time for them, right? And just because I'd been doing this for such a long time relative to others, it was very clear that I could do this, but that I didn't want to have higher responsibility of only being the only one committing capital, but rather having other folks bringing in capital, and then also having everybody else win with me, right? So kind of a communal aspect to it. And that's what a fund is all about. You raise a bunch more money from other people. And to be frank, having 25 million kicking around was not something that was a luxury that I had this year either. So I was like, hey, why don't I raise from other people? So that was kind of part of why I decided to raise the fund. To answer the last part of your question, which was like, how did I want to change the model? Well, when you look at venture, there's a couple of things. I'll talk about it from the perspective of the founder first, and then I'll talk about it from the perspective of the investor investing in the fund. So those are two things that, people are interested in hearing about. On the founder side, there's really weird incentives, right, for VCs. And what I wanted to change with Ascii, and that's the name of the fund, is I'll give kind of the general explanation of the fund first, and then I'll dive into the rest. But Ascii is a boring tech fund, focuses on companies that are not super sexy, doesn't have this crazy sizzle part, companies that are behind the scenes. Think, what is an inevitable business? What is something that eventually will have to be used and is on a daily basis, a part of people's everyday lives, but people don't even know it sometimes, and is making money. Now, I mentioned the companies now, a lot of people have heard of them, but they probably don't even know when they're using them, is like a Stripe and a Plaid, right? Like I would have loved to have invested in the Stripe and the Plaids of yesteryear, but now. So that is the premise of Ascii as the target companies we're going after. We have a couple of unique things we do. One is we basically try our best to, and legally I have to say that rather than the word guarantee, because you can't say guarantee. We try our best to help our companies raise the next round. So we actually created this incentive structure where we take on additional advisory stock. So we do ask for additional stock on top of what we buy in the round. And in return, we push for a firm or our own, actually, to be very clear, we could even do it ourselves, to help you lead your next round. And if we fail to help influence that decision or that next fund to lead your next round, or we weren't the source of that intro, we will give you that equity back. So the idea is to incentivize us to ensure that you're able to raise the next round. Because I would say most founders confidently want to raise that next round. That first pre-seed round of $500,000 or $1 million is not going to be enough if you want to build a multi-billion-dollar business. So we wanted to create that incentive structure. The second piece is we've created this thing called the action board, which, as you know, I've invited you on, and the red carpet is still laid out for you. And the idea of this action board is 150 industry-only people that could help our portfolio companies in two main areas. One is to become a customer, right? So if I ask you, hey, do you want to be a customer of one of the companies we've invested in? You would basically have to answer yes or no, which says there's no obligation to say just yes, but at least you answer. And then the second is through corporate development. So would a bigger company, obviously a lot of the folks on our action board are folks who are CMOs and major executives at Fortune 500 companies. The question would you want to buy this company? Because of course we want exits. And then the answer would either be yes or no. So we created this action board. We have this, call it assisted process to help with the second round. And that's kind of how we've made it very founder friendly. So that's on the founder side. And then on the investor side, very clear feedback I received on the investor side with Brian. Venture is a very long game. It takes me 15 years to make my money back, if even, right? Sometimes the cycles are even longer, and sometimes I don't get my money back. Obviously, this is the risk of investing in startup land. And so we decided to create a fund structure that was inherently divergent from day one. So we're actually investing in both early stage companies that are under, 15 million in valuation, let's say, and then also companies that are over 15 billion. Now we use this as a catchy line because what we're doing is we're buying secondaries in these later stage businesses. And because they're later stage, the timeline to them getting acquired or having some kind of liquidity event is not 15 years, it's more like 2 to 3 years. And if we're able to buy ones that are like a couple years out from an IPO, there's a bit of risk. And so you're able to typically buy at a discount. So we would do this. We're taking a third of the fund to do this. And that way the actual ability to return capital and return it faster is a little bit higher, right? Like, again, there's nothing that's guaranteed, but the fact that we have de-risked a third of the funds and we're using that to backstop the fund. Let's say we do, 5 or 6 million, we invested at 3-ish X, 3 to 4X within 3 to 4 years, which is kind of the general rule of thumb. You end up getting basically close to 20 million in returns within 4 years. That's the goal. So then now I'm back to 1X the fund, which is what everybody wants to be at, which is returning, your money to investors, and then everything else becomes great. So I'll stop there. There's a lot. It's very dense. That explains kind of all the different components of what I've been spending time on and what's been really, I think, requires some change in our ecosystem. But it is very tactical at the end of the day of how we wanted to do this and how we're manifesting this in the fund.
What I like about the approach for the founders is that you're not coming in, as an angel or a PE, putting some money in and then saying, "Hey, good luck. Let us know when you've raised the next round. Maybe we'll participate." Right? You're actually saying, "Hey, we're going to bring the money in, but we've got actually some stake, some equity that is not guaranteed, but it's contingent upon us helping you to raise that next round." And so you're really saying we're really in it for you to succeed. We're not just hoping it works out and then moving on to our next portfolio company and, placing 50 bets and hoping that of the 50, 5 of them work out, 25 don't, but the 5 that do are going to be home runs. And so it's fine. You're actually saying like, we really do want to stay involved and we know you need more capital than this. I think that's a really generous way of approaching it. And also you've been on the other side of that coin. So what it's like to be, to be taking in the money and then feeling the pressure to go raise that next round while you're also trying to innovate and grow a business at the same time. And they're two totally separate and distinct activities, right? And I know, so I think that's fascinating that you've sort of taken this lovely sort of founder-centric approach with an incentive for Ascii at the same time.
And founders want two things, right? They want to raise the next round and they want exits, right? And I know people don't really admit it, but it's true. Like sometimes you'll hear a founder be like, "Well, no, I want to build like a 100-year-old company and build like SpaceX." I'm like, "Bro, you're not like Elon, and come on," right? Yeah. And the game is, if you want to, and this is one thing I also learned with utmost clarity after being in VC land now on the other side, is there's a particular kind of asset that the VC can invest in, and there's a particular kind of asset that seeks out the VC as an investor. A lot of entrepreneurs just forget this. Like, your business, I don't think was VC backed, right? You built this thing from the ground up too, but Absolutely. Is that good or bad? No, it isn't. It's just how you did it. And your business, I would argue, is not a VC backable company, which is not an offense to you and is not an offense to me. It's just, it doesn't make sense. It's like asking a gold investor, someone who invests in metals and material and commodities, to invest in startups. They just don't. So it's funny when founders get really, really pissed off. And I felt this too, where you go to an investor, like, "What do you mean? And we're not a fit for your thesis." And, no, of course I'm a fit for your thesis. I'm awesome. I'm like, just because you're awesome doesn't mean you're a fit for the thesis, right? And this is actually, I would say, one of the big things I did learn, and that's why being on the other side is always great, right? Is because I now realize when these VCs were rejecting me, they were just so focused on that one area that they had built their entire fund around, and their background too. A lot of them have this background that led them to believe that area of focus is interesting to them. And that's what they're looking to invest in. And then this kind of weirdly inefficient way of pitching and pitches is how these companies and these VCs meet today. And it still is pretty inefficient, but unfortunately it's a people game. So that's what's led us to how this all works today in this industry, very much so. But that's kind of what I learned. And I think I could not fully understand it until I was on the other side.
Well, and you raise a good point, right? Like, so I've had my business now for 25 years, like this month actually, and it was self-funded. You know, there was four of us. We each put in 25 grand to start it, and then I bought out two of the partners in '03 and last in '08. And along that journey, we went from self-funded to the business became self-funding. And so I don't even know, I was just trying to go back in my mind how many companies or individuals have asked to invest in the business. It's somewhere between 5 and 7, let's say, over the last 25 years that have made serious moves to try to invest. But the reality was I didn't need the investment. And so it didn't make any sense for me to take the money. I didn't need to take money off the table. So I'm like, well, I don't need this. So not only am I not the right person for somebody externally to come in and invest in, I don't want it. Right. So, I've built what I had no idea. If you told me 25 years ago, hey, you're going to be doing this in 25 years, I would have probably said to you, really? Like, that's a long time. I think
That's a long time. Yeah.
maybe I'll exit at some point. But, and I still get asked that now, like, when am I going to exit out of this business? And I'm like, I don't know, I'm having fun and it's growing 25% a year. So I feel like I just want to keep going. It provides a great life for me and it doesn't restrict me in any way. And I actually don't have anything else I want to do right now. So, I think I'm not the right person to be invested in. And at the same time, I absolutely know people who are running businesses who are the right people. They need to take investment. They should take investment. And an investor would be smart to invest in them and in the business that they're. So I really appreciate you just like distinguishing the type of business that you really want to look at as Ascii and who do you think you can help. I also want to just double down on this investor side because I think, you've effectively built a hedge strategy, right? So if you're investing in these sub $15 million valuation companies, and then you're investing in these, 15 billion plus valuation companies with a third of the funds, that's your hedge, right? Like effectively you've created your internal hedge to say, hey, we're not just shooting for the moon with everything. We've actually gone after some stable companies with impressive growth rates, with a long-term track record, and we're taking subordinate debt that's available on the market. And this will provide it'll provide liquidity if somebody wants liquidity for your fund, but you're also hedging at the same time. At least that's my understanding of how you structured. Is that on track or?
Yeah, I think the concept of hedging is correct. I mean, the way we're doing is we're using investor funds, and it's part of our remit is the agreement that we have with them, and the goal is to create a bit of a flywheel, right? When you actually give people liquidity, because we're buying the stock typically from individuals. It'll be early employees, it would be co-founders that are no longer involved in the business. In some cases, it could be other funds that were early investors in those companies who have now timed out, right? A lot of funds have their timelines that have to be respected. And so they typically are in a bit of a hurry at the end to unload their positions and figure out how to wrap up that vintage of their fund. So we said, well, how could we help all these people out, right? And sometimes it is truly a win-win, right? In some cases, yes, we will buy at a discount. We're looking at stuff anywhere from a 30 to 50% discount to the last round. And people might go, well, that doesn't sound real nice. And I'm like, well, if you were an investor in the first round, you could care less what you're exiting at. I mean, you would be swimming in a lot of money, and you should be very happy that this is happening, and everybody wins. And then the fact that I gave you liquidity in a sort of a off-tempoed market, which is right now, is a really great thing. And liquidity is the biggest thing that is affecting VC world and angel investor world right now, to speak of the macro. The macro is that a lot of the cycle has been a bit mistimed. You have a lot of companies that are still growing really fast, that are massive on paper, think the open AIs of the world, but there's really no liquid market to allow a large participant category to receive liquidity in return for their stake in their holdings. It's unlike other asset classes where typically it's a bit easier to get liquidity when you're selling your real estate. But in the case of startup equity or business, private equity, this is a version of private equity. It is much more illiquid. So when we're doing this as a fund, we're now creating this liquidity. And as you can imagine, what do these people do? they usually return the favor in one way or another, right? Either they invest in my next fund, which is one of the goals, or they start to help out with our companies, or they start to get more engaged. And this has already happened. Like privately, I've already helped acquire myself and sell myself some secondaries. And I've seen how this happens, right? It's like a friend who helped you sell your house. They helped you sell your house, and that's what a broker and a banker does. But if they actually ended up buying your house, of course, you're like very happy for them. And like,
Yeah.
they're happy for you. Everybody's happy and everybody wins. It's such a, I love win-win-win situations. And this was very clearly one of those in the market we're in right now. Now, in 5 years, you and I talk and be like, Brian, secondaries for later stage decacorn companies is the hottest thing ever. I'll be like, probably not. The market's going to change, but as an investor, you're going to have to be nimble. You're going to have to change your strategy with the times. And that's generally how things go. Like you just can't stick with one strategy for the rest of your life.
Well, and the reality is, you're not buying grandma's stock at an arbitrage rate, right? Like that's not what's happening. What's happening is you are purchasing from a sophisticated investor who knew that they needed to get their money out in 5 years. The 5-year clock is ticking. They understand the market value of the security they hold is 30 to 50% of that value, but they got in at an early stage. So they're still making their lift on it. So that's part one. They're happy to sell it. Whether you buy it at 30 to 50%, it's on the market at that price. So they need the liquidity. All you're doing is helping them out by giving them liquidity. But it's interesting because you help them out by giving them liquidity, but now you've created a problem for them. They can't sit on cash. They have to reinvest that liquidity back in the next thing. So if you come knocking on the door and say, hey, I'm going to give you liquidity on that stock you need to be out of in the next couple of months. I'll get you out right now. I'll get you the money you need. Of course, at a discount, because that's just the market price for it right now. Also, I know you need to reinvest that capital into something, and I have the somethings that you could reinvest that capital in. So you're effectively creating this like virtuous cycle. As you say, you're helping each other, but it's really a virtuous cycle in fact that they need to reinvest. And now that you've got that relationship of trust on both sides, they have other opportunities. You might be interested. You have more opportunities. They might be interested. Is that effectively the model that you've crafted?
It doesn't have to be that explicit. It doesn't mean that they have to invest in the stuff that I send them. Obviously, that's the nice to have. Yeah. But I also say that it's the fact that they are now given some financial freedom and some financial optionality, and this is what most people are looking for when they're holding on to any kind of asset that's got some value behind it. And I would also argue they might actually have immediate needs. Some people are like, hey, I'm trying to buy a house, something happened, with health with a family or whatever. Who knows? My kids are going to private school. Who knows? There's all sorts of things. And so how do they get that? And I think it just depends on the market. And now there's more solutions out there. There are huge secondary marketplaces, but we're now also trying to take a bit more risk by looking at the companies that may not be as flush with liquidity. And you mentioned that sometimes there's a price out there. Sometimes with these companies, there might not even be a price, right? Because obviously with an Anthropic, there's thousands of people want to buy Anthropic stock, and if not more, and they're just well known. And I'm not going to get a discount on Anthropic price in the last round, I can tell you that, right? But there's going to be companies that are a little bit, more risky, that are a little farther out from an IPO, and those are the businesses that we would look at in a heartbeat.
Mm-hmm. Well, and the discount is also reflective of the risk. As I say, these are not
Correct.
arbitrage scenarios, right? Like
Correct.
the price has risk baked into that price that you're paying
Bingo.
as an investor.
Bingo.
Yeah.
Exactly.
So, it's such a fascinating model because you're seeing it from both sides of the coin. You're seeing it as a founder and as an operator, and now you're looking at it from the investor perspective, which you are also an investor, and you want to ensure that the people that are investing in your fund, that all of you do well from this. I'm really curious. So obviously, I always try to see things from a lens of leadership. So I'm curious, when you look at a company and you think this is a great idea, like this is one of those things that nobody really knows they need, but it's going to be a need coming up, and they're putting technology to something that technology has never been put to before. But once this takes off, everybody's going to have to do this. It sounds like the perfect Brian Wong company or Ascii company to go invest in. But what do you need to see from the leadership of those firms, of those companies? What do you need to see for you to feel like, great idea, but I also believe that the team, the CEO and the team that's in place can actually pull it off? Because there are so many great ideas out in the world that people come up with, but they just don't have the ability to make them real. So what are you looking for from a leadership perspective?
That's an excellent question. And it's very much a part of how we would invest. And every fund looks at just the people, but I think there's an important distinction that you just said, which was the leadership styles, the culture that they've already propagated, and also how they culturally interact with their peers and their partners, right? So I actually always try to describe culture internally, having operated for 10 plus years, to both the companies that I try to invest in and even folks I work with, which is culture is internal and external, right? It's like how you treat your own employees and how they treat you, and how you also treat your partners. And funnily enough, guess what? When I talk to a founder, I'm also a partner, right? If I'm going to invest in your company, I'm going to look at how you're treating me, and the level of respect that you treat me is how you would, I would assume, treat a lot of other folks that are in your orbit. And there's so many people surrounding you when you're in a founder role that you want to have that culture of respect. So I would say respect is obviously a big one that goes without saying. But I can use a tangible example actually, because this is public now. So there's a company that we invested in very recently, just a couple months ago, called Nexa, Nexxa. They recently got admitted into the Andreessen Horowitz speedrun program, and they have been just crushing it. If you look at all the posts that they've been putting out there, they just hit 1 million in ARR, and they've done this within like 4 months. And the team is insane. Now tactically, let me break down what makes Philip and DH, who are the two co-founders, CEO and CTO, so unique, and why we made the decision ultimately to invest in the company. First of all, I'll talk about them. They're agentic workflow automation. So just taking very, I'd say, menial or manual tasks in heavy industry and automating it. So heavy industry is their focus. So you're talking transportation, sort of lighting, plumbing, engineering, chemical, formulation, anything that's very, very heavy. They're going to be involved in automating some of those processes using their platform. So that to me was already a huge, ding, ding, ding. When I met them, was all like, this is perfect, right? Like no one's getting super excited in general when you look at the overall VC world about someone trying to automate locomotives and MRI machines or some part of it, right? So they and the guy who started it, he came from Siemens. And can't think of a more heavy industry company in the world than Siemens.
Yeah.
And he was leading innovation there, right? So already you could see he was, I would argue, swimming an uphill stream trying to bring innovation into I don't even know exactly how old Siemens is, but I'm assuming a very old company, and trying to make innovation happen. So that already was a good indicator, was his track record and him doing that. But one very unique attribute that I try to share with folks about founders that is a very good signal of a lot of other things is coachability. Now, there's a lot of different words for this, but one thing I found Philip very unique on was that he was an incredibly good listener, incredibly introspective, aware of the things that he wasn't necessarily on top of, very quick to seek help. He mentioned, hey, we're announcing our next round, our first round. I'm not that good at PR, Brian, but you certainly seem like you've been good at the PR thing. So let me ask you what we should be doing. And I gave him literally like 3 or 4 tips. And he listened to all of them, and he did most of them, right? And it was like, and I was like, this guy's like just perfectly coachable, very humble. The thing is, coachability doesn't mean he's clueless. It just means that he's just self-aware, right? And that, I think, is a big part of one of the indicators of that. As a leader too, being humble and aware of your own flaws is probably one of the top things that you should have. And that allows you to really attract a team around you that knows that you're conscious of those things, and that you want to build a team to help build the best team possible by bringing in people who are good at things that you're not good at, right? If you come out guns blazing and everyone thinks you think you're the best at everything, and everyone thinks you're the best at everything, or at least you think you are mistakenly, no one wants to work with you. And that's a huge indicator of how to build, I think, one of the best kind of world-class teams out there is to have that attribute.
That blend of coachability and humility, I think you've nailed it. Like, those are hugely important leadership behaviors. What comes with coachability is usually ability to coach others as well. So there's a flip, the other side of that coin is that they, instead of being the chief problem solver where they're absorbed in every problem and every issue in the business, they're actually good at coaching and developing the people that report up to them, which means they can actually develop the talent required to meet the growth of the business. So I think it's an underrated skill, because people think about coaching and they think, well, oh, I'll get a coach, but they don't think about how important it is as a leadership principle and something that practically you need to do basically daily.
Yeah, and it's a symbol, I believe, of a developed leader, right? Or someone who's developed to a point where they are fundable and can potentially run or grow a very, very big business. And I don't want to meet a founder that is, a little bit before that. I think it's best to just find a founder that's already at that point and have recognized these things among their career. And I'd say another huge one, and this goes with the first one, is understanding how to double down on strengths. And so that's a big part of the coaching part you mentioned. But really, to be more tactical, it's, I know you're really good at this, and I will make sure you're good at this. When I was running Keep, we would ask people to submit their own job descriptions of the roles that they thought they would be able to help with, and it was very opposite. Like, obviously we'd post jobs and job descriptions to attract certain kinds of people, but I would tell them, and we still do this to the companies that I fund or am involved with to this very day, is I say, hey, you guys, the first thing you should probably try to do is write your own job description, and you can axe out things that you just don't really want to do or are not that good at. And this sounds like, Brian, how can you possibly run a company with this? Like, people aren't going to hate menial labor tasks all day long. Of course, we're going to add certain things back in, but the idea would be, I want to know where you're efficiently using your time, right? Because most people, if you throw them into shit that they just don't really want to do, you're going to get 1/10 their productivity, and you're losing a ton of time. So absolutely, I cannot stress the number of people that I knew were extremely good at quarterly and monthly reporting. And I'm like, you go do that. This gets you excited. You do that, right? And there are people that are like, honestly, just they're phenomenal at it, right? And I say, hey, go do that, right? And they're very detail oriented, and they may be terrible at the big picture, right? If I say, hey, let me ask you what you think this business could be in 3 years, or why don't you come up with a strategic forecast for this business, they would never be able to do it. But again, it just depends on where people want to spend their time. And that, I think, is a big part of a leadership strategy that ultimately extracts, not to use a very tactical term, you're trying to extract the most value from your team at the time you're running them, obviously coach them to be a resource that can deliver long term. But if you're unable to move these Lego pieces into place and ensure that your team is optimally performing, you are not the best leader possible, I believe.
Let's talk about that from a practical perspective. So we have this tool that we use here for people, for leaders, when they want to review their job descriptions to figure out, what are the parts I like and don't like. And it's effectively, we take the job description and you get 3 columns: love to do, hate to do, willing to do, because I get it just got to be part of this job. And it's not my favorite, but I'll do it. And when people are able to put their job into those 3 buckets, it says, and then you look at where they spend their time and energy, there's a direct correlation. So, you can write all the job descriptions you want, but then if you were to just video and watch somebody for a week, you could pretty quickly figure out what it was that fit into those boxes. So that's part one. I want to just double click on a few things you said. So coaching, for those of you who are like, okay, I get how important coachability is, and I get how important being able to coach is, where do I even get started? The best-selling, most practical, best-selling in the last century, and most practical coaching book was written by a friend of mine, Michael Bungay-Stanier, who's actually been on the podcast this past year. He wrote a book called The Coaching Habit. And I think it's still the best book for leaders to pick up and learn how to practically apply the skills of coaching and development, and also to learn how to be coachable. The other thing I want to touch on is this concept of strengths. So there's a wonderful book called Strength Finder 2.0 that's actually paired with an assessment. And the assessment looks at 37 different possible strengths, and it narrows down what your top 5 are. And it's a quick assessment. I think it takes 15 minutes to do. What the book does is when you've figured out what your top five are, it says, okay, now let's figure out how to double down on those top five. Because I think a lot of times when we think about leadership or we think about development, people think, oh, what are my weaknesses? I should really work on my weaknesses. I need to get better at those things. The reality is, if you put a lot of time into your weaknesses, over time, you'll probably become average. That's your goal. I'm going to suck less at this thing I don't like doing and I'm not very good at. Whereas if you think about your strengths, if you put that same time and energy into those strengths, you could become world class at those things that truly matter and you're already really good at. And, I think the other thing we need to think about is when we think about a strength is something that I'm good at it and it adds energy to my life. I do it and I feel good. Like I'm like, yes, I love this. A weakness, obviously, is something that I'm not very good at it and it kind of takes energy out of my life. There's one hidden thing in the middle of all this, and that's something that I'm good at. People rely on me for, and it takes energy away from my life. And that's actually a weakness. Whereas a lot of people might look at that person and say, oh, no, that's one of your strengths. It's like, well, I hate it and it drags energy from me. So it's actually, for me, a weakness. And where people get trapped is they get trapped in something they're good at that other people rely on them for that they hate. And they just kind of go, I'm just stuck with this forever because I'm good at it and people like that I'm good at it. So I guess I just have to do this thing I hate doing and it exhausts me. So that differentiation between a strength and a weakness and a strength or something you're good at that takes energy away from you, this Strength Finders methodology will really help you to hone in on what those things are so that you can double down on what you're already strong at.
This is a typical Mike insight and why everybody should work with you. But yeah, that is 100% correct. I mean, there's definitely things that, you look at some folks and man, I feel bad for this guy because, everyone's going to him for this. And I can tell he doesn't like it. And I think sometimes earlier in your career, though, that is a stepping stone, right? Because you can see that it's enabling people to come to you and being a magnet and having people rely on you is a great way to unlock opportunity. And just knowing, though, what it is a big part of introspection. I think it's inevitable for most people, and I don't think it is for everybody, which is the sad part, that over time you recognize these things. I'm glad I had the chance to do this over, the 34 years I've been alive. Some people don't even get a chance to, right? So my only hope to most people, and I did cover it in my book, and that's why I always give this as an answer in podcasts, is like, know your strengths. Because that's the one cheat code in my book that I think I've carried to this day, is that the strength, the awareness part is the only way that you're going to make the most out of your career. Otherwise, you're just going to end up being in this never ending trough of, misery. And I'd say the worst thing in life is to have a career that isn't rewarding. It's probably something that I would not wish on my worst enemy. So I'm hoping everybody gets that chance. And that's really all we're trying to do here, right? And in your role and in mine is to be part of people's jobs and creating jobs that people love. That's it.
We've got about 2 minutes left and we haven't talked about crypto yet. We talked about Didi and the founding of that organization or that company. But let's talk about crypto. Let's talk about stable coins. What do people need to know? What do people like 2025? What do we need to know about the state of crypto?
So the nice dovetail here to use the last couple of minutes efficiently is, part of my fund is actually looking at avant-garde technologies, things that people don't really necessarily understand. Because again, part of investing in a fund is you want someone else who understands it to do it for you. That's what you're essentially giving the carry to me for, is because I'm doing it for you. I'm helping you out as your money manager. And one of the areas that I had exposure to in the last 4 years in the last company I built is in crypto, and really diving in on that. Early days with Keep, we launched the first blockchain-based ad campaign. I'd bought my first Ethereum and Bitcoin in 2018. And then, at the time, again, I looked like I had a third eye. People were like, what are you doing? Why are you buying this random, token coin thing that criminals and illicit governments are using to fund, weapons programs? And I'm like, listen, I think there's like a lot to the technology backing it. And so, and true to that. And again, I'm not trying to brag or anything, but today, I would believe crypto had become truly mainstream this year, especially with Circle IPOing, people realizing, wow, what is this USDC thing? What are stable coins? And so one of the areas we're focused on in the fund is stablecoin infrastructure, which basically is if we were around in the founding fathers days and we were printing US dollars and realizing what would the first bond look like? What was the first, sort of stock certificate? What was the first credit product that I could provide a business and whatever it is, or concept of credit? You could essentially invent that for stablecoins and just copy what had existed in traditional land and build it. And you're talking, think stablecoin remittances, stablecoin FX, stablecoin lending and borrowing, stablecoin banking, right? And there's a big bank that Peter Thiel just helped back called Erebor, which is a stablecoin denominated only neobank. Stripe just launched an L1, which is a layer one blockchain to power ideally all the transactions that Stripe processes rather than just the credit cards and fiat that we're dealing with today, called Tempo, and they raised $500 million for that. So I think people should be wiping out of their perception, or at least part of it, that crypto is weird and funky and for the edges, and now realizing that there is a very, very mainstream use case for it that is going to happen underneath people's noses. People don't realize this good chunk of PayPal's transactions are now running on chain. It uses PayPal's own stablecoin. PayPal has a stablecoin that you can actually buy in the PayPal app. Like, you don't even know this. You can go into the PayPal app today and buy PYUSD, which is a dollar-to-dollar denominated stablecoin. And you can also buy Ethereum and Bitcoin on your PayPal app and your Venmo app. People don't realize this, but PayPal now has a multi-billion-dollar crypto division. And so there's so many things happening right in front of people's faces. And I just want people to be aware of it. And this is a category we're looking at as a fund.
Love it. This has been such a fascinating conversation, Brian. I appreciate you making time to share your journey, to share what you're up at Ascii, to sort of educate us on how crypto has gone from what probably felt like things people played with on the dark web if you weren't in it. Yeah, I love it. To the Brian, for those of you who are listening, has held up a giant, almost looks like a shield with the words Ascii on it, his corporate logo. And if you're not watching this on YouTube or on Spotify, but anyway, so I appreciate you sharing all that, sharing where stablecoin is going, and that this is an inevitability for us, kind of like AI. It's just going to be in our everyday life, whether we want to or not. So might as well just dive in at this point. Thanks, man. Thanks for making time for this.
Thank you, Mike, as always.